All right, let's dive right into this explainer. We're going to break down the entire Indian banking system, tracing it all the way from its roots in 1770 to today's lightning-fast UPI. We're looking at the fascinating journey of how a system built entirely on trust and regulation evolved into a digital powerhouse that is literally leading the globe today.
Here's our game plan for today. We'll be covering 1. The big banking myth, 2. How banks actually work, 3. 250 years of history, 4. The modern banking pyramid, and 5. The UPI digital revolution.
Section 1. The Big Banking Myth. Let's get real for a second. We've all got this childhood image of our money sitting safely in some giant basement vault, right? You know, the ones with the massive round metal doors you see in bank heist movies. Well, scratch that. The reality? The second you deposit your cash, it is already heading straight into someone else's pocket. It's gearing up to fund a stranger's brand new house, their business, or maybe an EMI for a new bike. Your money isn't just resting, it's working overtime. The bank is essentially just sitting in the middle, using your deposits to fuel the wider economy, and yeah, making a pretty decent profit while doing it.
Section 2. How banks actually work. So, how do they actually make that profit? It all comes down to a centuries-old concept called the spread. Think of the bank as the ultimate middleman. Let's say you deposit 100 rupees and the bank promises you a 4% annual return. Nice, right? But they don't just hold on to your cash. They immediately lend that exact same 100 rupees to someone buying a house, except they charge that person 8%. When the borrower pays it back, the bank gives you your 4% cut and quietly pockets the remaining 4 rupees. That 4 rupee difference, that is the spread. It's literally the engine powering banking across the entire globe.
But wait, there's a massive catch here. What if you want your 100 rupees back tomorrow, but the bank already lent it out? Obviously, you don't want banks just gambling away your life savings. That's where the big boss steps in, the Reserve Bank of India, or RBI. They mandate these really strict guardrails. Basically, they lock away about 22% of all deposits. Currently, about 4% is kept purely in cash, that's the cash reserve ratio, and another 18% is parked in hyper-safe assets like government bonds or gold, known as the statutory liquidity ratio. So at the end of the day, only that remaining 78% is actually available for the bank to lend out.
Section 3. 250 years of history.
Now, getting people to actually trust this system didn't just happen overnight. It took over 2.5 centuries of trial, error, and evolution. For hundreds of years, India operated on the hundi system. It was this brilliant trust-based credit network that moved money from city to city without anyone carrying physical cash. Actual Western-style banking didn't pop up until 1770 with the Bank of Hindustan in Kolkata. Spoiler alert, it failed. In fact, hundreds of early banks completely collapsed due to fraud or just terrible management, right up until the British set up the presidency banks, which eventually morphed into the massive State Bank of India we all know today.
But for the longest time, there was absolutely no central boss calling the shots. The RBI itself has this crazy origin story. It actually started as a privately owned bank back in 1935, based on recommendations from the Hilton Young Commission. And get this, it was originally headquartered in Kolkata, just to be near British trade routes. They quickly realized, okay, it's pretty much impossible to manage a country this massive from one corner, so they moved it to Mumbai in 1937. Finally, in 1949, the newly independent Indian government officially nationalized it to print currency and firmly regulate credit.
Then we hit some huge turning points. After independence, banks were pretty much only serving the urban elite, leaving farmers completely at the mercy of local, greedy moneylenders. To fix this, in 1969, the government aggressively nationalized 14 major private banks, literally forcing them to open branches in rural areas. And hey, it worked wonders for social inclusion. But without any real competition, customer service completely tanked, and bad loans skyrocketed. That crisis forced the massive economic liberalization of 1991. Thanks to the Narasimham Committee reforms, private players like HDFC and ICICI were brought back into the game, completely sparking this new era of high-tech, wildly competitive banking.
Section 4. The modern banking pyramid.
Fast forward to today, and the institutions holding your money are organized into a highly structured pyramid under the RBI. At the very top, you have the RBI setting all the rules. Right below them are the scheduled banks. These are split into commercial banks, which are purely out there chasing profit, like your giant public sector banks like SBI or private ones like Access and Kotak. And on the other side, cooperative or regional rural banks that focus heavily on community and agriculture. Oh, and let's not forget foreign banks like HSBC, who actually dropped India's very first ATM into Mumbai back in 1987. This whole pyramid ensures that whether you need a slick corporate salary account in the city or a crop loan out in a village, there's a bank custom built for you.
In this incredibly strict structure, it is exactly why Indian banking is basically bulletproof. Think back to the 2008 global financial crisis. While massive Western giants like Lehman Brothers were being completely wiped off the map, India's strict RBI oversight stopped that kind of wild financial gambling from happening here. Western banks were essentially handing out home loans to anyone with a pulse without checking backgrounds. When that bubble burst, literally trillions of dollars evaporated. But Indian banks? They survived almost entirely unscathed. Why? Because the RBI's conservative rules, those CRR and SLR guardrails we talked about earlier, kept our institutions totally grounded.
Section 5. The UPI Digital Revolution.
All of that trust, built over decades of intense regulation, set the perfect stage for the absolute biggest financial revolution India has ever seen. Just wrap your head around this number, 23.2 billion. That's not a yearly figure, that is the exact number of UPI transactions processed in the single month of May 2026 alone. We're talking nearly 29.90 lakh crores in value. It's wild to think that when the Unified Payments Interface launched back in 2016, it only had a handful of banks and a few hundred transactions in its first month. Today, hundreds of banks are processing over 66 crore transactions every single day.
And to put that into a global perspective, India absolutely dominates the digital payment space. We hold a massive 49% share of all real-time retail payments worldwide. To give you an idea of how big that is, it's roughly 3 times larger than Brazil's PIX system, which is the next biggest player. Even the IMF has officially crowned UPI as the world's largest real-time retail payment system. What this actually means on the ground is that a small tea vendor on a street corner can accept payments with a basic QR code just as seamlessly as a massive multinational corporation. It is the absolute pinnacle of financial inclusion.
So here's the big takeaway. The next time you scan a QR code for a quick cup of chai, just remember that your tiny 1-second transaction is being held up by 2.5 centuries of incredible banking evolution. It is the direct result of failed colonial banks, massive nationalization drives to reach the poorest villages, the fierce technological competition of the 90s, and of course, the silent, careful watch of the RBI, making sure the whole shebang doesn't collapse. It really makes you wonder, with growth moving at this breakneck speed, what on earth will our daily transactions look like 10 years from now?